What is the stock market? The stock market refers to public markets that exist for issuing, buying and selling stocks that trade on the stock exchange or over the counter. Stocks, also known as equities, represent fractional ownership in a company, and the stock market is a place where investors can buy and sell ownership of such investable assets. An efficiently functioning stock market is considered critical to economic development, as it gives companies the ability to quickly access capital from the public. Purposes of the stock market: capital and investment income. The stock market serves two very important purposes. The first is to provide capital to companies that they can use to fund and expand their businesses. If a company issues 1 million shares of stock that initially sell for $10 a share, then that provides the company with $10 million of capital that it can use to grow its business, minus whatever fees the company pays for an investment bank to manage the stock offering. By offering stock shares instead of borrowing the capital needed for expansion, the company avoids incurring debt and paying interest charges on that debt. The secondary purpose the stock market serves is to give investors, those who purchase stocks, the opportunity to share in the profits of publicly traded companies. Investors can profit from stock buying in one of two ways. Some stocks pay regular dividends, a given amount of money per share of stock someone owns. The other way investors can profit from buying stocks is by selling their stock for a profit if the stock price increases from their purchase price. For example, if an investor buys shares of a company's stock at $10 a share and the price of the stock subsequently rises to $15 a share, the investor can then realize a 50% profit on their investment by selling their shares. Stock market players, investment banks, stockbrokers, and investors. There are a number of regular participants in stock market trading. Investment banks handle the initial public offering, IPO, of stock that occurs when a company first decides to become a publicly traded company by offering stock shares. Here's an example of how an IPO works. A company that wishes to go public and offer shares approaches an investment bank to act as the underwriter of the company's initial stock offering. The investment bank, after researching the company's total value and taking into consideration what percentage of ownership the company wishes to relinquish in the form of stock shares, handles the initial issuing of shares in the market in return for a fee, while guaranteeing the company a determined minimum price per share. It is therefore in the best interests of the investment bank to see that all the shares offered are sold and at the highest possible price. Shares offered in IPOs are most commonly purchased by large institutional investors such as pension funds or mutual fund companies. The IPO market is known as the primary, or initial, market. Once a stock has been issued in the primary market, all trading in the stock thereafter occurs through the stock exchanges in what is known as the secondary market. The term secondary market is a bit misleading, since this is the market where the overwhelming majority of stock trading occurs day to day. Stockbrokers, who may or may not also be acting as financial advisors, buy and sell stocks for their clients, who may be either institutional investors or individual retail investors. Equity research analysts may be employed by stock brokerage firms, mutual fund companies, hedge funds, or investment banks. These are individuals who research publicly traded companies and attempt to forecast whether a company's stock is likely to rise or fall in price. Fund managers or portfolio managers, which includes hedge fund managers, mutual fund managers, and exchange-traded fund, ETF, managers, are important stock market participants because they buy and sell large quantities of stocks. If a popular mutual fund decides to invest heavily in a particular stock, that demand for the stock alone is often significant enough to drive the stock's price noticeably higher. Bull and bear markets, and short selling. Two of the basic concepts of stock market trading are bull and bear markets. The term bull market is used to refer to a stock market in which the price of stocks is generally rising. This is the type of market most investors prosper in, as the majority of stock investors are buyers, rather than short sellers, of stocks. A bear market exists when stock prices are overall declining in price. Investors can still profit even in bear markets through short selling. Short selling is the practice of borrowing stock that the investor does not hold from a brokerage firm which does own shares of the stock. The investor then sells the borrowed stock shares in the secondary market and receives the money from that sale of stock. If the stock price declines as the investor hopes, then the investor can realize a profit by purchasing a sufficient number of shares to return to the broker the number of shares they borrowed at a total price less than what they received for selling shares of the stock earlier at a higher price. For example, if an investor believes that the stock of company A is likely to decline from its current price of $20 a share, the investor can put down what is known as the margin deposit in order to borrow 100 shares of the stock from his broker. He then sells those shares for $20 each, the current price, which gives him $2,000. If the stock then falls to $10 a share, the investor can then buy 100 shares to return to his broker for only $1,000, leaving him with a $1,000 profit. Analyzing stocks, market cap, EPS, and financial ratios. Stock market analysts and investors may look at a variety of factors to indicate a stock's probable future direction, up or down in price. Here's a rundown on some of the most commonly viewed variables for stock analysis. A stock's market capitalization, or market cap, is the total value of all the outstanding shares of the stock. A higher market capitalization usually indicates a company that is more well established and financially sound. Publicly traded companies are required by exchange regulatory bodies to regularly provide earnings reports. These reports, issued quarterly and annually, are carefully watched by market analysts as a good indicator of how well a company's business is doing. Among the key factors analyzed from earnings reports are the company's earnings per share, EPS, which reflects the company's profits as divided among all of its outstanding shares of stock. Analysts and investors also frequently examine any of a number of financial ratios that are intended to indicate the financial stability, profitability, and growth potential of a publicly traded company. Following are a few of the key financial ratios that investors and analysts consider. Price to earnings, PE, ratio, the ratio of a company's stock price in relation to its EPS. A higher ratio indicates that investors are willing to pay higher prices per share for the company's stock because they expect the company to grow and the stock price to rise. Debt to equity ratio, this is a fundamental metric of a company's financial stability, as it shows what percentage of company's operations are being funded by debt as compared to what percentage are being funded by equity investors. A lower debt to equity ratio, indicating primary funding from investors, is preferable. Return on equity, ROE, ratio. The return on equity, ROE, ratio is considered a good indicator of a company's growth potential, as it shows the company's net income relative to the total equity investment in the company. Profit margin, there are several profit margin ratios that investors may consider, including operating profit margin and net profit margin. The advantage of looking at profit margin instead of just an absolute dollar profit figure is that it shows what a company's percentage profitability is. For example, a company may show a profit of $2 million, but if that only translates to a 3% profit margin, then any significant decline in revenues may threaten the company's profitability. Other commonly used financial ratios include return on assets, ROA, dividend yield, price to book, PB, ratio, current ratio, and the inventory turnover ratio. 2 basic approaches to stock market investing: value investing and growth investing. 2 basic approaches to stock market investing: value investing and growth investing. There are countless methods of stock picking that analysts and investors employ, but virtually all of them are one form or another of the 2 basic stock buying strategies of value investing or growth investing. Value investors typically invest in well-established companies that have shown steady profitability over a long period of time, and that may offer regular dividend income. Value investing is more focused on avoiding risk than growth investing is, although value investors do seek to buy stocks when they consider the stock price to be an undervalued bargain. Growth investors seek out companies with exceptionally high growth potential, hoping to realize maximum appreciation in share price. They are usually less concerned with dividend income and are more willing to risk investing in relatively young companies. Technology stocks, because of their high growth potential, are often favored by growth investors. What is Bank Nifty and why to track Bank Nifty trend? Bank Nifty comprises of 12 most large capitalized stocks from Indian banking sector. Bank Nifty index shares almost 26% of Nifty. Bank Nifty has the highest weightage in Nifty. So in case of any news on Bank Nifty, it has strength to change trend of Nifty. Bank Nifty future has lot size of 20. Bank Nifty future trend is always volatile, so without getting proper technical analysis training it is difficult to find trend, and without trend you cannot take decision to go for buy or sell Bank Nifty. Also it is difficult to find perfect entry. What is stock trend and how to trade using it? Generally stock trader gets trapped in stock market due to lack of technical knowledge. They listen to friends and rumors and buy those stocks. Students should remember that when news about a stock comes, that is old news, and when general stock trader buys that stock, generally he buys at high level. You can know overbought and oversold zone of any stock in the page. So to avoid that, students should do technical analysis which shows entry and exit point and what big investors and operators are doing. If they are buying, then you buy the trend, and when they start selling, you exit. In this page only overbought and oversold stock list is given. Use the chart page to learn this trick. Before using this section, students those are interested in stock trading can learn and find the stocks which are in overbought and oversold zone. Overbought means maximum buying, stock is in higher level and profit booking may take place anytime, and these are bearish stocks. Oversold position means maximum selling, stock is in lower level and anytime buying may start, and these are called bullish stocks. Bullish trend and bearish trend stocks which come under derivative segment are updated daily using technical analysis charts, news and Nifty trend. Students are advised to check stocks position and technical chart present in need chart to learn how to choose stocks for positional trading. Before using stock trend data, find trend of Nifty future in intraday section, as stock generally follows Nifty direction. If Nifty trend is positive, then watch bullish stock. In case of negative, watch bearish stock for safe investing. In case of sidewise movement or swing trade, trade cautiously with stop loss and trailing stop loss.